Hi and welcome to EastTV. I'm Matt Windle and today I'm joined by Martin Smith, Head of Markets Analysis, to give us an update on deposits and lending balances. Hi Martin, thanks for joining us. What are some of the key highlights for Q4 this year?
Yeah, we're looking at our deposit funding and debt index, which is created by overlaying our demand side segmentation on APRA's monthly banking statistics. We've seen some really interesting shifts there in terms of how much businesses are depositing relative to their lending balances. And in the institutional segment there, I've seen a concerted shift away from credit. Really now the large top 500 enterprises by revenue with turnover of 725 million or more per annum are now almost depositing $2 per every dollar borrowed. Previously, they were borrowing more than what they deposited in the banking system. So a really interesting change there, and something that we expect to see continue.
Those trends being replicated market-wide?
Yeah, well, now that sees the institutional segment bracketed with micro businesses, which also borrow and deposit at a ratio of around 2 there as well. And really that business credit demand is being driven by the corporate segment, which we've reported for a significant period of time there now, but that's only eventuating in earnest further. So what we'd expect is that institutional enterprises will continue to deposit more than what they borrow from the banking system, and in order to generate greater business credit growth, currently just over 3.5% there, there needs to be a concerted focus on that SME segment, absolutely.
Have you seen any changes in the account tenants?
Yeah, well, we've seen a shift from retail on-call accounts to term deposit, and really that's been driven by underlying market characteristics, obviously equity market volatility there, amongst a number of other factors. But in that hunt for yield, that's definitely a key factor. And in terms of term deposit tenor, most retail depositors previously have looked for that shorter term account, but we're now seeing an attraction to longer dated term deposit accounts, which is really interesting. So from the bank standpoint, obviously with higher capital adequacy requirements, there's going to be a really interesting focus on how they can continue to generate profitability in light of putting aside more capital against loans, but also maintaining that return on equity guidance. Brian Hart's recommending 15% will be maintained despite upping investment up to about 1.4 billion in capital expenditure. So some really interesting movements occurring there on the demand and supply side in terms of deposits and lending.
Interesting times ahead. Thanks very much for joining us, and we'll see you soon for the next episode of EastTV.